Hello, everyone. Welcome to Demand Supply Trading Practical Session number 21 for the year 2025. Myself, Sujit Kakkar, and today is Sunday, 25th of May, 2025. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you related to stuff which is connected with demand supply trading methodology, be that the schedule of these live sessions, or it could also be other videos or maybe information related to demand supply methodology. So in case you're still not part of this Telegram channel and you wish to join it, there are a few different ways you can do it. The first one is you have the QR code on your screen. You can scan this and you can be part of the channel. Next, if you go to the description of this video, you will be able to find the direct link. You can click on that link and join the channel. And there is also another way. We'll talk about it as we move forward. But I would like to add that this week we did a poll on our Telegram channel, and the results which I got for the poll was definitely very shocking to me. Right now, why it was shocking, we'll talk about it next. So the poll was that if you haven't tried our 100% free 7 days trial of the demand and supply zone indicator yet, what is stopping you from trying that free trial? Now, the most shocking was the very first one, that 26% people said, I don't know that there is a free trial, right? We talk about this free trial almost every other session, and still 26% people said, we don't know that you are providing a free trial. Now, as we move forward with the session, I'll definitely let you know how to access the free trial. The link is again available in the description. You can also use that link to avail this free trial. But every session we talk about how you can have this free trial. The second result for, I'm not sure how to set it up, which was 11%. Again, it's not difficult. It's super easy. Probably it will take you less than a minute to do the setup. Now, how to do the setup: once you subscribe for the trial, once you fill the form for the trial, the email that you receive, it has the link to the page from where we have provided it step by step how you can do it. Plus, once you visit our demand supply zone indicator page, the walkthrough videos are also available. You can go through the walkthrough videos and understand, in fact, more about what the indicator is. But yes, to make it easy for you, I have again given the link in the description where you can click and see how to set it up. It's just few settings you have to do on the chart once the indicator has been activated for you. The next one was 19% people. They said, I don't trade regularly. Now, the beauty of demand supply methodology is, first, it works across all markets, be that the Indian markets, be that the international markets, be that stocks, commodities, forex, cryptos, right? Any market, and also across any time frame. So it doesn't matter whether you are into intraday trading, you're into swing trading, you do investment. The methodology is universal, and thereby the indicator also becomes universal. And even if you don't trade daily, this indicator will help you spot those powerful demand and supply zones on the chart. So whenever you trade, right? Let's say even you are more of an investor who only participates occasionally, but to participate, now be that as an investor, as an intraday trader, or a swing trader, you need to know where would be the right time to participate, or where would be the right time to book my profits. So the indicator helps with both the things. So again, even if you don't trade regularly, you can still try out the indicator for 7 days and see whether it helps you make better decisions when I want to enter a trade or when I want to exit the trade. And the least shocking one was definitely the last one, which is 44% people. 44% people said already using it and loving it. This definitely does not come as a shock to me. And the reason for that is because the indicator has not been designed by, let's say, a programmer, right? The fact is, I have been trading demand supply methodology since 2009, right? So it's been over 15 years I have been trading demand supply. So when I started with demand supply 15 years ago, I know, the challenges which I faced, right? Because back at that time, we didn't have tools like this. In fact, not just 2009, I would say for a very long period of time, maybe for 6, 7, 8 years, we didn't have any such tools which can help us with the analysis of demand and supply. So it was a lot of struggle. And since it has been designed based on my 15 years of experience doing demand and supply, I know the challenges which people face specifically when it comes to demand supply methodology. And all those challenges have been incorporated not just into our demand supply indicator, all the demand supply tools that I've created, be that the alerts, be that the screener. So definitely when you do have the opportunity, you should try it out, because you can see over 44%. In fact, I should not have said over 44% of people you can see who have been using our indicator. They definitely love it, because it makes life really, really easy. Be that identifying the zones, or be that our other tools, which is the alerts or the screener. All right, so that being said, let's move forward. So like I was talking about, there is another way you can join the Telegram. So for that, first, what you need to do is you can visit our website, which is surjeetkakar.com, or in case you want to use the short URL, that will be sk.coach. So now once you're on our website, you can scroll down on any of the pages, and at the footer, you'll be able to find a join Telegram and join now button. So you can simply click on this button and you can join the Telegram channel. All right, so that takes care of how to be part of the Telegram channel. Now moving forward, what this session is all about. So again, every weekend I do a practical session on the application of demand supply methodology, because when you go through our course, again, our demand supply course is now available as a 100% free course. How can you access the course? We'll also talk about it as we move forward in the session. But once you are done with our demand supply methodology course, you basically learn the methodology theoretically. And to understand it practically, I do these practical sessions where we take some examples. To those examples, we apply the complete methodology, and that helps us understand how to plan trades very mechanically and rule-based using demand and supply. All right. Now, the best part about these practical sessions is that when I do the analysis, we are not picking something which has already happened and then justifying it, because that's a piece of cake, right? You can pick any chart, you can apply any indicator, oscillator, something which has already happened. It's always very easy to justify. Now, the beauty of demand supply methodology is that we call it as set and forget methodology, which means we can pre-plan the areas where we would like to be buyers and sellers. And whenever in the future prices revisit those areas of demand and supply, that is the time those trades, they get triggered. And that is how we plan trades in these sessions. We plan our trades in advance, and just because we are planning our trades in advance does not mean that I share the analysis with you and then we forget about it. Whatever analysis I share with you, whenever they get triggered in the future, we always start with the review of it, and that helps you see both the before as well as the after. And when you're seeing the both before as well as the after, it helps you build confidence in the methodology. Now, for today's session, we don't have any examples which are pending for review, so we can straight away start with our analysis for today. So just give me a second. Let's bring up the chart. Just a second. All right, so perfect. Let's get started. Now, in fact, before we get started, a few more things which I like to add. Right now, again, when we talk about these practical sessions, there are some prerequisites, and if you complete these prerequisites, this will make the sessions much more comfortable for you. Now, what are these prerequisites? The very first one is our Trading Essentials course. Now, the reason it says optional is for someone who already has a very good trading background, has been trading for a number of years. You can skip this if you wish to. However, I would definitely recommend everyone to go through our Trading Essentials course. But if you're a fresher, then definitely you can't skip it. You'll have to go through the Trading Essentials course first. Now, how do you access the Trading Essentials course? Very simple. Once you're on our website, under services, you'll be able to find the option which says courses. And here you can see the very first one is Trading Essentials. Click on it. The course is available in 2 languages, English and Hindi. Whatever language you're comfortable, you can click on it. You will immediately get access to the course content in a form of a playlist. So you have your lessons laid out, lesson 1, lesson 2, lesson 3. So just go through all the lessons, and that basically covers your Trading Essentials course. Again, no sign up required, no registration required. You simply click on this button and you'll have immediately access to the playlist. Now, once you're done with your Trading Essentials, the second prerequisite is your demand supply trading course. So to learn demand supply trading course, it's again the same thing. The services, you have courses, and now you can see the second option is demand supply trading. Click on it, and this course is also available in both languages, English as well as in Hindi. So whatever language you're comfortable with, you can click on it, get immediate access to the course playlist. Plus, see, what happens is when you go through the course, like I was talking about, it covers the course theoretically. Now you also need to see some practical examples. So you can click on practical sessions, and this will give you access to the playlist of the previously recorded sessions. So all these live sessions that I do, we also record them. So currently we have an archive which is almost about 1.5 years of recording. So you can click on whatever language again you're comfortable with and have access to the recordings of all the previous session. You can watch as many practical sessions as you wish to. Definitely those will be the recordings of the previous session, but we also do live practical session every weekend, so that is where you can also join in live. And during these live sessions, if you have any questions, queries, doubts, you can also put it in the chat box, and at the end of the session I help you with your questions, queries related to demand supply methodology. All right. So the next one is during the live sessions, you will see that when I plan trades, I plan them very mechanically and rule based, and we also talk about it as we move forward that trading definitely has to be very mechanical and rule based. Now, to make the process mechanical and rule based, I have designed 2 documents for you. The first one is the rulebook, the second one is the flowchart. Now, how can you access these documents? Again, on our website under services, go to downloads, and here you'll be able to find the rulebook and the flowchart. So you can click on these download buttons and you'll have access to these documents. So this is your rulebook and this is your flowchart, and how to use them, you will see it during the practical sessions. All right, so now that we are done with the prerequisites, let's get started with our session example for today. So the first thing I always start with is that when it comes to trading, always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. In case you have still not watched that video, the link is available in the description. Make sure you watch that video, understand the process. You will have to go through that process maybe once, maybe twice, but there is no bypassing it. So the sooner you start with the process, the better it is going to be for your trades. So again, since we need to be mechanical and rule-based, we need to create something which is called as a trade plan. Now, I do understand when you are learning trading as a fresher, or even when you're learning a new methodology, in this case, it might be demand supply trading for you. As a fresher, it's not very easy to create a trade plan from day one, because to create a trade plan, first you need to have good enough experience of that methodology. Only then you can convert it into a rule-based process. Now, to overcome this challenge, like I said, I have already created these 2 documents for you. So this is more like your initial trade plan, which you can start using to plan trades very mechanically and rule-based. And as you start having more and more experience, you want to make some modifications to it based on your trading style, based on your personality style. That can definitely be done. So what is our step number 1 whenever we start planning our trades? Step 1 is I need to define my trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade, and the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why am I starting with the trade purpose as my very first step? And the reason we are doing this is because when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We again go with a very logical approach. And that logical approach is that the longer I want to be in the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So what I've done is, just give me a second. Right. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, by definition, I said daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, like let's take example of the NSE India market. So what you would have seen is whenever you're trading markets which are not 24-hour markets, whenever the market opens, some symbols they gap up and some symbols they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight in a market which is not a 24-hour market, we do have that add-on risk of a gap, a gap being created the next day, which could be against you. So what we will be doing is, as a risk management rule, to avoid this unnecessary gap risk, initially our hourly dailies will be strictly intraday trades. Now for weekly monthlies, anyhow, we are not expecting to get the exit the same day. Here we know that these trades can last for a few weeks or maybe few months. So here you have no choice. You'll have to keep these positions as overnight positions, but that does not mean you cannot have a gap against you in case of weeklies and monthlies. It can still happen, but since you're leaning against some bigger time frames, the probability definitely reduces, but it can still happen. Always keep at the back of your mind. But as you start having more and more experience, you start building up confidence into your analysis. If you want to include the daily incomes into overnight trades, that can also be done. So again, my step 1 is I need to define my trade purpose. Let's assume I opted. I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if you go to page number 28 on the rule book, we start with the topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. Now, what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. The intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries, like your type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help you. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Now mind it, the table which is on page number 31, this is specifically for the NSE market, because this market is only open for about 6 hours and 15 minutes. But if you're trading markets which are open for longer durations, then you can refer to the table which is on page number 32, like for your commodities, forex, cryptocurrencies, or maybe if you're trading some international markets which are open for longer durations, then you can look into this table. But since I'll be taking examples from the NSE, I will be following this table. And we assume that let's take an example that I want to plan monthly income trades. So from this table, I got to know that as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is the intermediate, used for trend analysis. Lower time frame will be daily. That is where we get our SETS from. SETS stands for stop loss, entry, target, and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine-tuning the zone, type 2, type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number 1, I have the clarity to what time frames I'll be using. What time frames I'll be using, plus what is going to be the purpose of each and every time frame. So my challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but if we take again the example of NSE, on NSE we have over 2,000 companies listed. So humanly not possible that every day I sit and analyze 2,000 companies. So what I need to do now is I need to have a process in place which can help me get a smaller list out of this big list, because if I have a small list, I can do my homework, I can do my analysis almost every other day. But going through 2000 plus symbols, not an easy task. In fact, I'll say next to impossible for every day. Maybe you might do it for a day or two, but you cannot do it for every day. So how do we do this? For this, we use certain computer programs for selecting a smaller list of scripts. And these computer programs are called as scanners or screeners. Now, if you'll do a Google search, you'll be able to find a number of free scanner screeners, which are based on either conventional technical analysis or fundamental analysis, and that can help you get a smaller list. But again, like I said, all these tools that I've developed is based on my 15 plus years of experience with demand and supply. So I do understand that there is a very big challenge that there are no scanner screeners available on demand supply methodology. So to overcome this challenge, I also created two custom built tools. One is called as the demand supply zone alerts. The other one is called as the demand supply zone screener. Now, once you click on this, it will definitely take you to our product page where we have provided the walkthrough videos. You can watch those walkthrough videos to understand them better. I'll also quickly show you on our website how you can reach. So once you're on our website, under services, you'll be able to find TradingView indicators. And here you have the option for alerts and screener. You can visit the product pages. You can watch the walkthrough videos to help you understand what these tools are and how they can help a demand supply trader for shortlisting some symbols, which is purely based on demand supply zones. So again, step 2 is to get a smaller list. How you get that small list, completely your choice. You can use conventional technical analysis based scanner screeners or fundamental analysis based scanner screeners. You can also use scanner screeners which are purely based on demand and supply. The process can also be as simplified as I want a small list. I will only be analyzing my Nifty 50 stocks, or maybe I have my own favorite list of symbols which I want to analyze every day. So choice is yours, how you want to get that small list. A number of tools are available. But always remember, irrespective what scanner or screener you're using, whatever results you get from these scanner screeners, you can never blindly buy or sell these symbols, because scanner screeners, they do not tell you what you need to buy or sell. They only help you get a smaller list. Once you have that list, you will have to analyze them one by one. And out of this, whatever matches with your trade plan can be an opportunity for you. Whatever doesn't match with your trade plan, you simply skip it. So let's assume we got a list. And in that list, the very first one was ABC. So what am I supposed to do now? On ABC, I need to go to the lower time frame and identify zone. And by zone, we mean any of these 4 structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. Now, the best part, which I was talking about, that we did a poll, and the most shocking result was almost 25% people said that we don't know that you provide a free trial for the demand and supply zone indicator. So this is where we always talk about it. So how do you get access to the free trial of the demand supply zone indicator? Very simple. Once you're on our website, under services, go to TradingView indicators. Again, I'll add the direct link is also available in the description. So once you're here, you can click on the demand supply zone indicator, and here you can see you have the option for 7 days free trial. Click on it and you simply have to fill this form. Just few things you have to provide. First, how did you hear about us, right? So it's self-explanatory. Next, you have to provide your full name, your email address, and your TradingView username. Now, very, very important. When you're filling your TradingView username, make sure you're filling it correctly, because if you're providing an incorrect TradingView username, it will not get activated for you. It will get activated for whoever owns that TradingView username. Now, in case you don't have a TradingView account, you can click here and you can sign up for a free TradingView account and then provide your TradingView username. In case you already have a TradingView account, you can click here to visit your TradingView profile, identify your correct TradingView username and provide it. Now, once you have filled this form, within 24 hours, the indicator will get activated for you, and then you can try it for free for 7 days, fully functional. And once it gets activated, you will receive a notification on TradingView that it has been activated for you, and then you can start using it. All right, so now you know how to get access to the indicator, and since now everyone has that opportunity that you can try the indicator for free at least for 7 days, and you also saw that almost 44% people, they are just loving the indicator, because like I said, it has been designed based on my experience, which definitely gives you a lot of advantages versus when you're doing your analysis manually. Anyways, so since everyone now has that opportunity, we will be doing our analysis purely based on the indicator. So let's go to our chart. And here you can see that as soon as I applied the indicator is telling me that we do have a zone here. Now, I have been saying this almost since the time we created this indicator, that this indicator is not based on boring, exciting technique. This indicator is based on price action. So few things which you can see in this zone is, first and foremost, you can see that even though this is not a boring candle, the indicator is telling us that this should be taken as part of the basing. This should not be taken as a leg in. So that is the very first thing. The beauty of the indicator, it is based on it is based on price action. It is not based on boring, exciting technique. The other thing you can also see here is that, let's say, even if I take both these candles as basing candles, then my leg in is a green candle, which means it should be taken as a rally, and this should have been a rally-based rally. And for rally-based rally, my distal line should have been here. So why is the indicator taking the distal line from here? So again, like I said, it's a very advanced indicator. It is not based on just boring, exciting techniques and the color of the candle. Now, even though you can see it as a green color candle, technically it is a bearish candle, right? So because it is a bearish candle, the indicator understands that this is not a rally-based rally. This is a drop-based rally. Now, however, we have given you this option in the indicator. Like you can see, the leg-in method is based on the candle type. So what do we mean by candle type? Whether it is a bullish candle or whether it is a bearish candle. So since this is a bearish candle, it is taking it as a drop based rally. Now let's assume that my preferences, I want to do it based on the color of the candle. So if I change it to candle color, now you will see it will take it as a rally based rally, and my distal line will shift a little higher. Can you see now it has shifted a little higher? And this small variation can be a difference between a stopped out trade and a trade which works for you, right? So you can see that yes, we have given those options, but the default option is how price action works, right? Price action is telling me this is a drop based rally, not a rally based rally. In fact, what I'll do is, if I just do this for you, display the pattern name and hide the proximal distal value. So now you will be able to see, can you see currently it is marking it as a drop based rally, even though it is a green color candle. Now if I change it to candle color, now it will call it as a rally based rally, because based on the color of the candle, yes, we can take it as a rally based rally. You can see it has changed to rally based rally. But yes, technically it's a drop-based rally. So let me now remove this. Perfect. So again, a very beautiful example that how beautifully the indicator has been designed. And like I was talking about, it is based on, again, it has not been designed by any programmer, because if a programmer is or a coder is designing it who doesn't know demand supply methodology, these nuances can't be taken care of. The fact is, I know a little bit of coding, so all these tools which you are seeing has been coded by me based on my experience, and that is why they have been so fine-tuned, and that is why you can also see that almost 44% people said they are loving it. It's just that many, very huge percentage haven't even tried it. So once they start trying it, probably this percentage might go to 70%, 80%, or maybe even higher. Again, let's go back. So yes, we do have a drop-based rally structure. So let's draw this drop-based rally. So yes, I have identified a zone now, which was my step number 3. In fact, I didn't even have to identify, the indicator did it automatically for me. So on the lower time frame, identify a zone. Do we have a zone available? Yes, the answer is yes, we do have a zone available. Now, once you have identified the zone on the chart, doesn't mean you can blindly trade it. The next step is to qualify it. So let's start with the qualification process. It's a two-step process. In step 1, we'll qualify it based on certain conditions, and in step 2 we'll qualify it based on the booster scoring. So the very first one is level on top of level. We'll check, can this zone be a case of level on top of level? Now how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what this tells me is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which is called as a coinciding level. So if we have a coinciding level, it can be a case of level on top of level, but if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone I have identified, does it coincide with any intermediate time frame zone? And here you can see on the intermediate, we do have a drop-based rally structure. So let's draw this. So what you can see now is that this pink color zone is my intermediate time frame zone. The green color zone is my lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes. So now that we know we have an we have a coinciding level, the next step is we'll have to check, do we have a case of level on top of level or not? Now mind it, when it comes to level on top of level, it is not mandatory that the other zones need to be quality zones. So what I need to do now is, you can see currently the indicator is identifying only quality zones. So I'll tell the indicator, I just don't want quality zones. I want all demand supply structure. So I'll enable this. And now the indicator will identify all structures of demand and supply. And now you can see that the indicator is telling me that if you're looking for all structures of demand and supply, I can take this as a rally-based rally structure. So we have one demand zone and then we have another demand zone, which is right here. And the fact is, if I enable gap-based zones, right? So if I do this, I need identify overnight gap zones, right? So can you see, if I enable overnight gap zones, we also have a zone which is right here, and that is because of a gap, and that's a rally-based rally structure. So since I can visually see, generally now I always prefer to keep it disabled. Why I like to keep it disabled? Because I'm pretty sure all of you understand that every day the market opens, we always have a gap up or a gap down, be that maybe just a 5 paise. So once you enable it, you can see the indicator will identify n number of zones which are based on gaps. And that is the reason I prefer to keep it disabled. I like to use it visually, but yes, we have given that option here. But we can see that we do have a gap zone, which is from here, right? And if you talk about it, I can also call it as a drop-based rally based on the structure. So since we also have another zone which is based on a gap, and as of now it is an unfilled gap, I can even draw it as a zone. So what I can see is that inside of my intermediate time frame zone, which is this one, just give me a second. So that's my intermediate time frame zone. We do have multiple zones, and those multiple zones are, this is the very first demand area, this is the second demand area, and this is the third demand area, which is because of the gap. And like we talked about, if you have an intermediate time frame zone which gets divided into multiple zones on the lower time frame, we call it as a case of level on top of level. So we do have a case of level on top of level, and it's a very beautiful example where you can see that in case of level on top of level, it might not just be one zones, it can be multiple zones. So yes, we do have multiple areas, and what we should be doing in such a case, to have the maximum probability stacked in our favor, we should be going for the lowest zone. And this is why I picked it as an example, so that we can see that even though we have a quality area, but based on the fact that it is a case of level on top of level, we had to shift to the lowest zone. Now, one tweak, which I'm pretty sure all of you would have seen me doing it over and over again, that is when we have coinciding levels, I prefer to have my stop loss from the distal line of the intermediate time frame. So I'll definitely make that modification here as well. Plus, I would also like to add that if you want to further fine-tune your zone. So just as an example, if I say I want to see overnight gap zones, so can you see here we have an overnight gap zone, and I can also say that I want the proximal line from the gap, right? So gap zones proximal from the gap. So you can see now my proximal line is coming from here. So if you want to fine tune your entry, you can also take your proximal from the gap, because we know it is still an unfilled gap. So prices can come here, fill the gap, and again move up. So yes, just to fine tune your zone, if you wish, you can shift your proximal line here, wherever the fill of the gap is, but we'll keep it the way it is. So we'll take it as a drop based rally structure. It's just that the distal line has been fine-tuned. So yes, it was a case of level on top of level. We made the modification based on that. So let's move forward. Next, is the zone because of a gap? The answer is again yes, the zone is definitely because of a gap. So if you have a zone which is because of a gap, what we need to do now is we need to apply the gap rules. So if I go to the rule book and we look for the rules of gap, the gap rule says that first, whenever you're using your gap as a demand or a supply area, it has to be an overnight gap and an open gap. We have already verified this. This is an open gap. And since some of the daily chart, this is also an overnight gap. The next condition is that we only use pro gaps, and whether it is a pro gap or a novice gap, we have to check in on the daily time frame. So what is the definition of a pro gap? A gap in the opposite direction of the price. So wherever the dominant price direction was, if we have a gap in the opposite direction to it, so here you can see that for a pretty long time prices have been moving down, right? And then we got a gap up. In fact, if I just go to a weekly chart, you can see we have been moving down and then we got a gap up. So this basically tells us that maybe we are at some cheap price, and at cheap price somebody is buying a little expensive to get a bigger fill, which definitely makes this as a pro gap for us. And since it is a pro gap, and since it is also an overnight gap and an open gap, this qualifies for us. This will not be applicable because this only applies to symbols which are making all-time highs or all-time lows, right? Which is not the case for this particular symbol. So yes, we applied the gap rules. Based on the gap rules, this is definitely qualified for us. Now, the next one is pivot and no authenticity. Definitely, it is again a drop-based rally structure, which we call as a pivot or a no-authentic zone. But to this one, we don't have to apply the pivot no-authentic rules. And the reason for that is you can see that in the additional rules in the rule book, I've given you that for a pro gap, even if it is a reversal pattern with less than 3 candles in the basing, we can skip the rules of pivot and non-authenticity. And the reason we can do that is because we know it is a gap, and gap zones, they always have that extra edge, the positive factor we are looking for. And since we have that positive factor, we look for when it comes to the structure of pivot and non-authentic zones, adding any extra probability is not required. Just being a pro gap is sufficient for us to use this as an opportunity for us. All right, so that takes care of pivot no authenticity. Unstable equilibrium is not applicable. So after looking at all the applicable conditions, is the zone qualified? The answer is yes, because it did not get disqualified due to any of these conditions. Now, the next step is to do the booster scoring. So I'll have to be a little fast now because I also have the Hindi session scheduled at 12:30. So I'll just pick up some speed now. Let's quickly get done because I also have to take your questions, queries at the end of the session. So I want to get done with the analysis really, really quick. So talking about freshness, since we still have an open gap, it is fresh, gets a score of 3. Gaps, they always get a score of 2. Time at the zone, we have only 1 candle in the basing, which is again a score of 2. Reward to risk ratio will take as an assumption. Talking about location, if I go to the monthly chart, which is my higher time frame, you can see that we do have a monthly zone, and from there we are getting a reaction. So my zone is located inside of my monthly zone, which is the best location to plan a long trade. Gets a score of 2. Trend becomes irrelevant. Doesn't matter whether we are in an uptrend, downtrend, or sideways. At this location, all kind of trends, they get a score of 1. Move from the zone, we need at least a 4:1 move. Let's see, did we already have a 4:1 move? So you can see 1:1, 2:1, 3:1, a little over 3:1. So we don't have a 4:1 move as of now, but yes, prices can move up and then they can start coming back, which might upgrade it to a score of 2 eventually. Currently, it will be a score of 0. It was a case of level on top of level. We have already verified that. It is also a coinciding level. And talking about trap, if I take a horizontal line wherever my proximal is, and if I zoom out and now start pushing it up, trying to find an area where prices have been bouncing over and over again. In fact, if you just look at this area, you can see in the recent past, it has beautifully acted like resistance, resistance, resistance. Here it has worked like support. And if I bring in more data, you can see even in the past, it has been working like support. So we do have a pretty clean area of support resistance, and our zone is sitting right below it, which can make it work like an area of trap, right? So for trap, also I'll give it a score of 1. So if you look at the overall scoring, we have a score of 10 out of 10 for quality, definitely with the assumption of the reward to risk ratio, and 6 out of 8 for probability, which makes it as a high quality and a high probability trade setup. And high quality, high probability can be traded as type 1 trades. So after applying the boosters, we got to know this is going to be a type 1 trade for us. Now, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we also need to be ready for the worst case scenario, for which we'll do a proper position size calculation, which is part of your risk management. Now, whenever the prices are back, we'll re-verify, does it still qualify based on my trade plan? And the reason for that is the markets are not static, markets are dynamic, conditions are changing almost every other second. So before participating in a trade, we always have to double check that does it still qualify based on my trade plan. If the answer is yes, we place our order based on the entry type, in this case a type 1 trade. And once your order has been executed, the last step is your trade management, where step 1 is 1:1, we make it as a break-even trade. And after that, if you get the opportunity to trail onto it, we start using a trailing stop loss. And this is how we plan trades, very mechanically and very rule-based. Now, before we move ahead, I would like to add that these sessions are helping you. Do like the video, share it with your friends, family members who are into trading, or if you're part of some trading group, do share in those trading groups as well, because I know a lot of people are struggling with trading, and you never know, these sessions might help them. Plus, like you saw at the starting of the session, that even the people who are on my Telegram group, Telegram channel, they don't know that we provide a free trial. So you can also share the link to my free trial with your trading groups, so that more and more people can take advantage of it. They can try it out. And yes, before we get into the questions, queries we have in the chat box, I would also like to add a very common feedback I was getting was that during the live session, YouTube live session, we can't share our charts, or what if I don't want to ask my questions publicly? So we do have an option for a one-to-one session. So if you want to schedule a one-to-one session, you can do that from our website, wherein you have two choices. One is your voice call, the other one is your online meeting. So if you feel that on a voice call, you can ask your questions, queries, get the answers, you can schedule a call appointment for it. If you feel that I want to share my analysis, I want to get it reviewed, you can also go for a online meeting, right? So that option is definitely there. But yes, other than these two options, you can always post your questions, queries in the chat box during these live sessions, and I try to answer all the questions that we get. So let's see what do we have in the question box today. Why are you not trading options? Now, the reason I don't trade options is one, we have very limited number of symbols which have good liquidity. Plus, once you go through the options course, you will also see the kind of conditions that we require. Generally, it's not very easy to find those kind of conditions. So that is the reason I don't trade options. Plus, I somehow feel more comfortable with the stocks. And the reason for that is because I mostly do monthly income trades, which means these are positions which I might hold for a few months. But what will happen with options is that at the end of the month, we have the expiry, so I'll have to close those positions, or I'll have to roll over those positions, which I generally don't like to do. So those are some of the few reasons why I don't trade in options. So you were in US when you were with OTA? No, I was not in US. I was doing, the courses for OTA India, which was in Mumbai. So that time it was only in Mumbai, but now I believe they are at other locations as well. So yes, it was in Mumbai. But again, I was more of a freelance instructor for them. So I did it for about 5 years, from 2012 to 2017. Okay, so in the last session, I asked one question regarding how to do upward pyramiding, means adding more quantity in run trade. We have a rule in trading stop loss, but see, again, I definitely answered that question during the last session as well. So what I answered was that, let's say if you're already in a trade and eventually now you have a formation of a new demand area, and that new demand, so I'm taking an example of a long trade, right? And that now that new demand zone is again qualified based on your trade plan. So when the price revisits those areas of demand, you can again take that trade, right? It's more like on the same symbol, you're taking a new trade, right? Which is basically helping you with scaling it. So that's how it has to be done. So how do you combine this methodology with options? First, build the view of the script and then trigger option strategy based on your view. So again, absolutely. So again, an option trade, I will say again, starts as a demand and supply trade. So once you have decided, okay, whether I want to take a directional trade or a non-directional trade based on these demand and supply areas, then we check how's the implied volatility. So again, our options course is also 100% free course. So you can go through that options course to understand I'll just show you. So under services, go to courses, and you can see you have the options trading course as well. So go through this course. This will help you understand how to look at implied volatility and then decide that based on the current implied volatility, what kind of trade I would like to take, right? But yes, it always starts as a demand supply trade first to define whether you want to take a directional trade at demand or supply, or you believe that until expiry prices will remain within this demand and supply zones. So maybe I want to do a non-directional trade. Okay, so I'm marking zones on multiple stocks every day, but it's 1 month since I executed a trade. What to do? See, again, it completely depends upon how many symbols you're looking at. And again, also depends upon what style of trading you're doing. So again, if you're doing monthly income trades and let's say you are looking at maybe only 20, 30, 40 scripts, you might not get an opportunity almost every other day. So those are the factors. Now, again, if you're looking at only 40, 50 scripts, but you want to plan, let's say DIT trades, you might get an opportunity almost every other day. So a lot of factors will count. One is what style of trading you're doing and that leads to what time frames you're using. Next, the quality of the zones you're looking at. If you're only looking at best of the best zones, definitely you'll have fewer number of trades. But again, I'll add, having fewer number of trades does not mean you cannot make a lot of money, right? And to understand this better, if you go through the last session of the year 2024, where we reviewed all the trades that I shared with you during that year, go through that session. That will help you understand that even if you get few number of trades, it's absolutely fine. There is nothing wrong with it. And you will also be able to see you can still make good percentage of money as long as you're sticking with your trade plan. All right. So how it is a open gap. The zone was tested. How does an open gap? Again, if you talk about open gap, a gap always starts from the closing price, right, to the opening of the next price. So you can see if this was 100, let's assume this was 102. So we have still come to maybe 100.50, but unless and until we reach 200, it will still remain as an open gap. So the gap closes at the closing, not at the high, right? So it has gone a little tad below the high price, but this is where the gap starts from. Again, green color candle, so that's the opening, that's the closing. So, and this is the opening. So price has to reach until the closing price for this to be a gap which has been closed. So what I'll do is I'll just take a horizontal line here so that you can see it much more clearly. Can you see if I take a horizontal line, this is where the horizontal line is, and we still have a gap which is this much, right? You can see we still have a gap which is this much. Perfect. So that answers your query that it is not a filled gap. This is still an open gap. The gap is not filled from the high or the low. It is filled unless it gets filled. It will only get filled once the prices, they reach the closing price of this previous candle from where it gapped out. Okay, so when the price comes back to your zone after hitting the very high, very low of the curve, the probability of the trade setup reduces. Can you explain this? So if you go through the, I guess, last to last session, right? Not the previous week, the week before it, I specifically took an example which was based on this rule, that is when the prices are coming back to the zone after hitting the very high or the very low of the curve. And this is one reason why I always keep saying that not just these live sessions, try to watch as many previous sessions as possible, because see, in one session, I can't take every kind of example. But when you look at, let's say 20, 30, 40, 50 previous recorded sessions, you will be able to see almost every kind of example. So I guess we covered this, probably it was the last to last session. So just go through that session. It was specifically based on this rule. I picked that example. I am on free trading view plan, and can I use twice screener indicator to monitor more stocks and one demand? See, now the problem is on a free trading view account, you can only add the 2 indicators. So since you can only add 2 indicators, one will be your demand supply zone indicator to help you identify the zones on the chart. So you'll only be left with one. But again, this is the limitation of the free account. But yes, what you can do is that when you're adding that one, you can have a list of up to 40 symbols. Once you have scanned those 40 symbols, you can again remove those 40 symbols. You can add the next list again. So that could be the only alternative, because you can only add 2 indicators. You cannot add, or what you can do is you can first add the indicator twice, the screener, you can add it twice, scan 80 symbols, and again, once you're done with the scan, you get the results from the scan, then remove it, then add the indicator, and then start with your analysis. So you'll have to figure out what works best for you for a free trading view account. Do you offer indicator for more than 1 year plan, or will you be offering in future? No, currently the longest duration we provide is 1 year. And the reason for that is because we are leaning on TradingView, right? Now, what if eventually TradingView makes some changes to their website where we get some limitations or restrictions? So taking that into consideration, we don't provide subscription which are longer than annual, so that everyone is on the safe side. And we are not even planning to increase from 1 year, because if you just have to subscribe it once a year, it's not a very big task. All right, so that brings us to the end of today's session. Thank you everyone for joining in. I will be seeing you now the next weekend. Until then, trade safe, enjoy your Sunday, take care, bye bye.